forward with our next set of guests. Joining us live now, Suvodeep Rakshit from Kotak Institutional Equities, as well as Bhaskar Panda from HDFC Bank. Thank you, gentlemen, for joining us here on ET Now. Suvodeep, I'll come to you first. Like I said, 76.32. We've not seen that on our screens in nearly 20 months. Yes, it'll impact exports. It's good news for exporters. They'll just earn more. Bad for imports, bad for oil imports, bad for many people who might be traveling for holidays. They'll have to pay more for whatever it is they purchase over there. But just seeing the rupee's performance and the double whammy of inflation that's creeping in, is it alarming? Is it just in line with what's happening the rest of the world? Because we've not seen that many interventions by the Reserve Bank either.
Hey, good morning. I think, it's an interesting point that you raised that, whether it should be alarming. I think there is no cause for concern because if you look at the movement in the rupee, it had been holding steady for a very long time, despite we having a weak trade deficit numbers, despite having flows which have reversed over the last few months. So there has been a bit of weakness, which, at least in the fundamentals, which were pointing to the reason why rupee should depreciate. But I think the depreciation now comes on the back of the dollar index moving higher, and the Fed showing a much more positive intent of tapering as well as hiking rates. So I think it's in line with what the fundamentals globally look like and what it kind of dictates. So I think it's not a cause for concern. And I think on the intervention part also, the RBI would have wanted to get some clarity in terms of how the global flows or the global monetary policy, especially from the Fed, would pan out. And I think we are starting to get a better sense in terms of the global monetary policy. We had ECB, we had BOE, we had the Fed, all over the last couple of days, and we now have a better sense in terms of what the global picture is starting to look like. So, kind of curbing volatility in terms of the FX movement, I think it gives a better clarity to the RBI now if it wants to intervene, rather than, kind of coming in at every level and trying to defend a particular level. I think that RBI never has done that. And I don't think it is also prudent to do that, especially given how how volatile the markets are, how uncertain the economy, the activity levels are. So I think it's now in a better position to kind of take a call on how to intervene, when to intervene.
Bhaskar Panda, coming to you now. We've seen what the FOMC has had to say. We've seen what the Bank of England has done with an out-of-turn rate cut after seeing inflation hit a 10-year high. Back home, the expectation is not before March, April will we see the rate hike. How are you assessing this situation given inflation and the depreciating rupee?
Inflation as transitory. I think that was a mistake that everybody has now realized, and probably the action from BOE shows the way how others will follow. You have correctly mentioned that ECB is already moving tapering. Fed has already increased the tapering. To $30 billion per month, so on and so forth. And we cannot be far behind in that sense. However, we have a very unique or peculiar situation here. We have to also manage our growth coming out of the pandemic, and we also have to manage the expectations of the entire country. So, in that sense, probably I don't foresee any rate hike coming from RBI in next few meetings. However, the tone of RBI's communication could keep on changing, depending on how things are going to turn out from here. On the dollar rupee front, I think 76.30, 76.50. These are all numbers, and probably there is a support at 76.59. That is a it's a technical kind of number. However, the one thing that we need to remember, the import that was down in the pandemic is past us. Therefore, we are going back into normalcy. In a normal period, we are always, deficit in current account, deficit in, in trade account. Therefore, structurally, rupee is going to depreciate against a dollar. And especially when dollar has moved or dollar index has moved so high and oil still remains sticky above $70 per barrel or 75 around $75 per barrel, we cannot expect rupee to appreciate too much from here. However, the capital flows in last couple of years have been good. I expect that to, I mean,
Bhaskar, I have a
the
simple
capital flow.
question. Reserve Bank
Yeah.
of India will have to start controlling inflation. A weak rupee is actually bad news to control inflation. So you may want to keep interest rates under check. You may want to keep inflation under check. But ultimately, if the rupee is going the way it is going, inflation is not going to come under control.
See, if you look into the inflation index, I don't think depreciating rupee contributes too much. I think, if I remember correctly, it contributes only 0.2 or 0.3% of to the inflation index. So therefore, too much depreciation is bad. Obviously, yeah, I agree with you. However, you cannot keep rupee from depreciating because fundamentally we have to depreciate, and that everybody knows. Bigger question is that whether oil will remain here, will come down, or will go up. So that is the bigger question that we need to worry rather than worry about the rupee depreciation. Honestly.
So if there are three rates in any country: inflation, interest rates, and currency rate. Any central banker or any government can try and control two rates, whether it is a combination of interest rates and inflation or whether it's a combination of currency as well as interest rates. Just for the benefit of our viewers, I'm making this point that China for the longest time did control their currency because that in a sense is something which they thought would have aided their export market. So my question is that do you think now the priority should change? The priority right now is keeping interest rates low and inflation under check. But do you think the priority now needs to change?
So you're right in pointing out the three factors, and which we often refer to as a trilemma. You can't control everything at the same time. I think till now, let me put it this way: till now you're focusing on growth. The moment the comfort on growth comes in, the worry on the inflation increases. So that's the point when you're trying to explicitly target inflation, which currently you have not been doing during the pandemic. So I think the RBI shifts focus on the inflation as soon as they get some comfort that, okay, there's a variant, growth concerns are there. Let's say in the next couple of months, they get some clarity that no, there is no concern as such coming to growth. I think inflation comes back into focus. And just drawing a point on the impact of exchange rate on inflation, Mr. Panda talked about it. But if you look at the basket of CPI, around 17 to 18% of it is coming from the global-led inflation, right? A very large basket is anyways, domestic factors led. Obviously, there is some spillover, etc. But again, the point that I make is that addressing inflation will become a target or will become the primary concern. And I think that shift happens probably early next year. It does not mean that they have to raise repo rates. All they have to do is kind of start normalizing liquidity and normalizing the reverse repo rate, kind of squeeze the corridor in and then ultimately go in for the repo rate as and when they are comfortable with it. But the point essentially is that if you are choosing those three rates, inflation will start having a dominant effect sometime early next year, when the comfort on the growth also comes in. The exchange rate, I think, is a byproduct in some sense. And why do I say a byproduct? Because it's moving because of dollar, it's moving because of crude prices, it's moving given the kind of capital flows that we see. An interesting point would be, when does the bond inclusion happens? And it's a lumpy flow that you'll get. And how does the rupee react then? And how does the RBI react to the capital flows that come in? Because it has liquidity implications also. So from that perspective, there are a lot of exogenous factors that come into the rupee. And it does not necessarily make sense to kind of target the exchange rate. However, if you are targeting the inflation, if you're keeping that in control, that anyways has a knock-on impact on the exchange rate, given the interest rate differentials, inflation differentials from a medium to long-term perspective. That is what matters. So I think the job is very clear that if you're inflation targeting central bank, you come back to that target, and you come back to that objective. And that obviously is because inflation is a concern. If tomorrow it happens that inflation is no longer a concern, then the approach for the RBI might be very different. But as of now, for the next few months, we know that core inflation will be a worry. Inflation on the headline is also much above the 4% mark. So as soon as you get some comfort on the growth, you start targeting the inflation front.
Okay, gentlemen, we're going to leave it at that. That's all the time we have for today. So, of course, you're seeing the dollar index, the way it's moving, Indian currency depreciating, 76.32, not seen it for 20 months. The unenviable task of central banks worldwide. You can't control inflation rate, interest rate, and currency rate. At best, you got to choose two of the three. Thanks so much for joining us.